Hey everyone, Will here, founder of GoToMarketGuru.com. In this particular mini lecture, we're going to talk about the technology space, and in particular, different stages of company from seed and Series A all the way to post-IPO. I'll give you a breakdown of what to expect in each one in case you want to work in one, from risk, structure, revenue, growth expectations, and more. I hope you enjoy, and if you do, as always, please feel free to like and subscribe and check out my website, GoToMarketGuru.com, for professional software sales courses. Thanks so much, and bye for now.
This is something I'm super passionate about, and it's basically looking at the developmental stages that a company can have. And the metaphor or analogy I'd like to give you is that companies follow a developmental pattern. They start off early, then they grow, and then they mature, just like, the flora and fauna around us. So let's think of a seed. A seed is planted, it's given, good soil and water and nutrients and sunlight, and then it grows, into a small plant, and then that plant grows further, and then it becomes a big tree that bears fruit. And then maybe that tree multiplies and plants more seeds, and then it becomes an Amazon, a big tech, Goliath like we know today. So companies grow just the same way as other elements within nature do. And they have the same names too. So early stage companies are called seed stage companies, quite literally. Then they go through something called Series A, Series B, Series C plus. I put C plus because there is a Series D and E. And then post-IPO, post-initial public offering, and then they become these big tech firms. And so in the next slide, we're going to dive into understanding the characteristics and trade-offs of each particular stage, whether it be early, growth, or mature. But if you have this analogy in mind, it's super easy to understand. So we'll go ahead and look at those stages, the seed, Series A, B, and C, and post-IPO, and we'll look at it for different factors. So we'll look at the stage, we'll look at the type of growth trajectory it has, we'll look at how old it is, how many FTE stands for full-time employee count, we'll look at average revenue per stage, kind of growth profile per stage, how much funding and what the valuation is, and then what the level of risk for the company, business risk is, and what level of structure is inherent within the company. So, starting off with seed, the earliest stage of company, it is classified as a startup. It's probably only been around for 1 year, 2 to 10 full-time employees, FTE. Revenue probably, nothing more than $500,000 annually. Growth is in the thousands of percent annually. And what I mean by that is if you have $10 in revenue and then you go to $1,000 in revenue, that's a 1,000% increase, just to give you a sense of what I mean by that. So it's fairly easy to have a high growth rate early on. Funding, a seed stage company has probably received between $100,000 and $2 million in funding. Valuation-wise, probably valued at $5 to $10 million. Valuations in the technology space are usually based off of a multiple of revenue early on because they're not profitable. So if it has $100,000 in revenue and 10x multiple, then that's $1 million valuation. I might make another course on valuation, but to go further, risk very high for seed stage companies, and level of structure on a 10-point scale, very low. So, I'll give you an analogy later on as well, but they're considered to be pirate ships. So basically everything goes, not many people are a jack of all trades. As you move to Series A, still early, still a startup, but now it's been around for a few years, 30 to 50 employees, let's say, $1 million plus in revenue. Growth profile now has slowed down. So not the thousands, but now it's in the hundreds of percent. Funding, they've received more money, they're valued higher, the risk has gone down from very high to high, and the structure has gone up slightly. So what I want you to start paying attention to now is not the actual numbers, but the trends, particularly in the type of company, in the growth profile, in the risk profile, and the amount of structure. So as they get bigger, they get less risky, they embody more structure, and they move across the growth profile. Series B is gone from early stage to growth stage. Now it's not a startup, it's a scale up. More revenue, slower growth, gone from thousands to hundreds to low hundreds, funding more, valuation more, risk has reduced from high to medium, structure has gone from 2 to 3 to 3 to 4, same trend, Series C. It's a scale up, slowing growth profile, lower risk, more structure, post IPO, so the company hits the public market. Now it's not a scale up, it's a public entity. They've been around for a while, they've got lots of revenue, much slower growth profile, mid-10s, maybe 50% year on year if they're lucky. Risk has gotten pretty low, and I say this, tongue in cheek, but relative to the beginning, it has. And then more structure. So now they have an HR department, and they have, firm hierarchies and firm interview processes and job descriptions and so forth. And then finally, you have mature big oak trees / forests, big tech, your Amazon, 10 plus years, billions in revenue, 100,000 employees, and low level of risk. It's not going anywhere tomorrow. And then structure, fairly high structure. They hire MBAs. They've got, 5 interviews in order to get in. You know the idea. But essentially, the big trends here are there are many different company stages, and in the sales course that follows, in particularly how to break into the industry, I'm going to talk about how to prepare and guide you to each one, and talk about the trade-offs of working for each one, and then in the how to become an account executive, I'm going to give you best practices for succeeding depending on what stage that you choose. So having this perspective in mind is extremely relevant. And lastly, to tie that off, I wanted to give you one more analogy. Early stage companies are like pirate ships. And as I mentioned, jack of all trades, everyone's kind of running around doing everything, low level of structure, but super fun. I've worked on 2 pirate ships now that went through the transition stage, and I found that this is what suits me. Some people, however, they love mature navies, so they like working for Google or Amazon, where everything has a structure and a method to it, and a lot more security. There are trade-offs to each. Personally, I like early or growth, but a lot of people like mature and Navy as well. But great analogies to have in mind, and you'll hear this a lot, pirate ship and Navy.